Welcome to the official Technests YouTube channel, and thank you for spending your time here today. If you're a futures prop trader working through evaluations, managing drawdown rules, and trying to turn funded accounts into consistent payouts, you're in the right place. At Technests, we build automation tools for U.S. futures prop traders so they can trade with structure instead of emotion. Our flagship system includes Dr. Markets, which helps you design rule-aware trade plans, and TradeRx, which helps enforce those rules through automation and produces clean, audit-friendly trade records that keep you aligned with the prop firm's requirements. Before we begin, a quick but important disclaimer. This video is for educational and informational purposes only. It is not financial advice. Futures trading and prop trading involve substantial risk, and you can lose money. There are no guarantees of profitability, funding, or payouts. Always read your prop firm's rules carefully and manage risk responsibly. Now, let's get into today's topic: how to choose the best prop firm for futures trading. And I want to start with something that might sound obvious, but most traders don't fully internalize it until they've paid for it. The futures prop trading world is booming. It has never been easier to sign up for an evaluation and take a shot at a funded account. With as little as $50 to $300, you can join an evaluation that advertises $25,000, $50,000, even $250,000 in simulated capital allocation. And that kind of access can feel like a breakthrough. But access is not success. Because in futures prop trading, the most important market isn't ES, NQ, or gold. It's the rulebook. And the real secret behind long-term prop trading isn't just having a strategy. It's choosing a prop firm whose rules actually allow your edge to survive. Some firms build rule sets that give traders a realistic path to passing, scaling, and withdrawing. Others create evaluations that look passable on paper, but are designed in a way that produces resets, subscription revenue, and churn. So the goal of this video is simple: not hype, not the best firm list fluff. This is about clarity and survivability. How to choose a firm where your risk profile, your instruments, and your trading style actually fit the environment. Because if you choose the wrong firm, even a strong trader can fail repeatedly. Not from bad trades, from rule friction. So let's start with how futures prop firms actually work. Most futures prop firms are not structured like hedge funds. They're not funded primarily by performance capital that depends on trader profits. Most of their revenue comes from evaluation fees, reset fees, monthly subscriptions, add-ons, and partnerships with execution or data providers. That means the company has to walk a careful line. Enough traders pass to create success stories. But most traders fail often enough that the firm remains profitable. And you don't have to hate that business model. You just have to be smart inside it. Your job is to choose a firm whose rules give you a legitimate path to survive long enough for your strategy to play out. Because rules, not charts, determine whether you last. Now we need to talk about the rule category that ends more futures prop traders than anything else. Drawdown structure. This is the quiet killer. And it usually comes down to one key difference: trailing drawdown versus static drawdown. A trailing drawdown follows your equity as it rises. If you make $1,000, the trailing threshold moves up. And if you give that profit back, even temporarily, you can hit the drawdown line and fail. It's brutal. And it's especially brutal on volatile products like NQ and gold, where normal movement can swing your equity fast. A static drawdown is different. It's fixed. Once you move above it, it doesn't keep chasing you. And that one difference can turn a firm from stressful to survivable. So when you're evaluating firms, don't just glance at the drawdown number. Ask how it behaves. Because a trailing drawdown doesn't just measure risk. It changes how you trade. It forces you into defensive decisions. It encourages premature profit-taking. It creates pressure to avoid normal drawdowns. And that pressure creates mistakes. Now let's talk daily loss limits. Daily loss limits can disqualify even good traders, especially on days where the market is noisy, choppy, or simply not cooperating. For ES and NQ, you want daily loss caps that reflect real futures volatility. If a firm's daily loss limit is too tight, you're not being tested on skill. You're being tested on whether the market stays calm enough for you to avoid a rule breach. And when daily loss rules are involved, clarity matters. Does the firm flatten positions automatically? Do they lock you out for the day? Are you allowed to continue the next day? Is a reset required? Good firms make these rules clean and understandable. Bad firms make them vague and stressful. Now we get to the category that frustrates traders the most because it feels unfair. Consistency rules. This is where a trader can be profitable overall and still fail. Some firms require profits to be spread evenly across multiple days. So even if you have a strong week with one great day and several smaller green days, you can still fail consistency. And the tricky part is that different futures products don't produce consistent-looking profit distributions. ES has slower, steadier movement. NQ tends to have bursts. Gold can be calm for hours, then violent around releases. So if a firm has consistency rules, you need transparency. You need to see the math. You need the definition to be clear. Avoid vague consistency language, because vague rules are easier to enforce in ways that feel arbitrary. Now, news trading restrictions. This one matters more than traders realize, because futures markets move hard around major events. CPI, NFP, FOMC, GDP, Fed speeches. Some firms ban trading during high-impact news. Others allow it with specific windows. And here's what you want as a trader. You want clarity. You want defined restricted windows, not ambiguous language like major events, because if the rule is vague, you can take a trade that makes money and still get flagged later. For NQ and gold traders especially, permissive and clearly defined news rules can make a huge difference, because those instruments often deliver their cleanest movement around volatility catalysts. Now, let's talk about scaling plans. Scaling is how the firm increases your allowed size as you hit milestones. Healthy scaling plans start small, scale logically, and allow growth over time. But some scaling plans are designed to look exciting, while keeping you capped with restrictions that bottleneck your progress. So when you look at scaling, don't look at it like a dream. Look at it like a pathway. Does it scale up reasonably? Or does it keep you small for far too long? Because growth isn't just about passing. It's about what happens after you pass. Now, platform and data compatibility. Execution quality is everything in futures. If you're trading on NinjaTrader, confirm the firm supports it properly. If you rely on Rithmic, confirm it's available. If you use Tradevate or CQG, confirm stability. Avoid firms that force proprietary platforms with laggy charting, limited automation support, or unstable connections. Because execution friction kills evaluations. It turns good setups into poor fills. It creates unnecessary slippage. And it increases the chance of accidental rule violations. And if automation matters to you, this is critical. If you want systems that help enforce discipline, you need stable platform support. Now we hit the real test. Payout policies. A firm can advertise huge profit splits, but that doesn't matter if payouts are slow, complicated, or inconsistent. Strong prop firms typically offer payout cycles that are clear and timely. They have low payout minimums. They avoid hidden fees. And they don't create endless compliance barriers right when it's time to withdraw. If you see red flags like long delays, complicated paperwork loops, or repeated reviews before payouts, pay attention. Consistency in payouts is a sign of firm health. Now, reputation. Marketing is not truth. Research what active traders say, not just promotional content. Look into community discussions, forums, and real trader experiences. You're looking for patterns. Do they change rules without warning? Do traders report payout issues? Do they have platform instability? Do they terminate accounts for unclear reasons? Firms come and go fast. Longevity and transparency matter. Now here's the part where we bring it home. There is no single best prop firm. There is only the best prop firm for your trading style. If you're aggressive, like an NQ scalper, or a gold breakout trader, you'll usually need rule sets that tolerate volatility. Static drawdowns. Permissive or clearly defined news rules. Flexible scaling. If you're more conservative, like an ES trend trader, you might do better with firms that have structured rules and end-of-day limitations that align with your pace. And if you plan to run multiple accounts, you need to ensure the firm supports it cleanly, not just in theory, in practice. Now let's ground this in real-world behavior. ES traders often benefit from stability, because ES tends to move in larger but more controlled ranges compared to NQ. A static drawdown firm can help ES traders survive chop days without the drawdown line constantly chasing them. NQ traders live in speed and volatility. That means you need wider daily buffers and realistic drawdown behavior. Because NQ can swing far enough to end an account quickly if the rule set is too tight. Gold traders often feel news restrictions the most. Gold reacts aggressively to economic releases. So if a firm has strict news rules and you trade gold, you either need to avoid those windows completely or choose a firm with clearer, more permissive event rules. Now let's talk about what happens even when you choose a good firm. Most traders still fail for one consistent reason: rule violations, not bad setups. They overtrade. They oversize. They trade in restricted windows. They try to get it back. They drift from the plan. And this is where Technests fits into the prop ecosystem. Dr. Markets is built to help you interpret firm rules and shape a plan that makes sense inside those constraints. It helps map restricted windows. It helps design risk that fits the drawdown structure. It helps you build a plan that respects both your style and the firm's limitations. TradeRx helps enforce that plan through automation. It can prevent trades during restricted windows. It can help keep behavior aligned with predefined risk thresholds. It can track your actions and trade records so you can review what happened with clarity, not emotion. This is not a promise of success. It's a reduction of avoidable mistakes. It's infrastructure for discipline. Now, before you choose any futures prop firm, I want you to pause and ask the essential questions. Is the drawdown static or trailing? What is the daily loss cap like for ES, NQ, and gold? Are consistency rules involved? And is the math clearly defined? Can you trade news, and are restricted windows clearly stated? Does the firm support your platform and execution feed properly? How fast are payouts processed in real trader experiences? Can you run multiple accounts cleanly? And do real traders consistently trust this firm? If any of those answers feel vague, reconsider. In prop trading, vagueness is expensive. Now let's close with the core principle. The best futures prop firm isn't the one with the flashiest marketing. It's the one whose rulebook aligns with how you trade, what you trade, and how ES, NQ, and gold actually behave. Great prop trading isn't only about beating the market. It's about choosing the right environment so your edge can breathe. If you want help navigating drawdown traps, consistency rules, and event restrictions, you can visit technests.ai to explore Dr. Markets and TradeRx, our flagship tools designed to support automation and rules-aligned execution for U.S. futures prop traders. Thank you for watching, and thank you for being part of the Technests community. In the next video, we're going to do something traders rarely do properly. We're going to take a real prop firm rulebook and turn it into a practical survival map for ES, NQ, and gold. We'll walk through the exact moments traders usually break rules, what those mistakes look like inside trade records, and how to build a system that blocks them before they happen. If you want that video, subscribe, turn on notifications, and share this with a prop trader who keeps resetting evaluations and deserves a smarter way forward. Thank you again for being here, and I'll see you in the next one.